Hey there, welcome to the part 5 of our online course. And in this particular session, we are going to understand risk management. In the last session, I said that we are going to have a look at risk management and position sizing, but I thought let's not confuse by taking up all the concept at once. So I'm keeping position sizing for next session, and in this session, we are going to have a look at risk management. Now, risk management in itself is a very big concept and very big topic. So please pay attention because this is where professionalism gets differentiated from gambling. This is where institutional players get differentiated from retailers. This is where professional traders get differentiated from retail traders. This is very important because once you understand risk management, you will not look at the markets from the point of view you are looking right now. Most of you probably are looking at markets right now from this perspective that let me go into markets, let me put some money and let me make double of what I am investing in few months or few weeks. And that is okay because that is how everyone looks at markets in the initial phases of their trading and investing careers. That is how human psychology operates. That is how we function. So that is all right. But after today's session, I do not expect that from you because today we are going to learn something very important, something that will change your perspective about markets forever. So let's start off by understanding what is risk management. So, as you know, markets have two sides, meaning the winning side and the losing side. Two directions, upside going direction, downside going direction. So, which means it has two probabilities. Like whenever you enter into market with some money, whenever you trade, there are two possibilities that either you are going to win or you are going to lose. Is there any third possibility? No. When the market goes sideways, what happens is either you are losing small or either you are winning small. There's no third option in between these, right? So why does it happen that 95% are 95% of people are losing money when the maximum probability of losing money is 50%? Ever wondered this? Ever thought about this? Let's say if 100 people are entering into market at once, and because market has only two sides, someone is going to win and someone is going to lose, isn't it? So how does that come that when the maximum possibility of losing is 50%, how are 95% people losing money? Out of these 100 people, according to this theory, only 50% should lose and 50% should make money, isn't it? Because someone is buying and someone is selling. So if someone has bought the markets and if the market goes down, then that guy will lose and the other 50% will make money, isn't it? Or the vice versa thing. If someone is buying, market goes up, those guys will make money and the other guys will lose. So this is pretty straight, isn't it? Like there's 50-50 chance of making money in the markets or losing money in the markets. Then why and how are 95% people losing money? This is where risk management begins. So, to explain it in a better way, I'll have to go to Paint to explain you a few concepts. Before that, so as we understood in the last session of Fibonacci, we saw this retracement zone. Okay, so let's say this is a support or resistance, and the markets are consolidating over here, and let's say they break down. Now, there are people who sold over here, okay? There are people who sold over here, and there are people who also bought over here, thinking that this is a support market might reverse from here. I will book profits over here, and something of that sort. So, at any given point of time, there are going to be people who are buying in markets, there are going to be people they are selling in the markets, right? So, now market goes down. Now, the people who sold here should make money. All those who sold over here should make money, isn't it? Because the markets went down, they shorted the markets, and whoever that bought over here should lose money. It is simple. Are you getting it? It is not that complicated to understand, but still 95% people are losing money in the markets. Now, this is a question. How is it even possible? The theory says not more than 50% is the losing chance or winning chance. So, how are 95% people losing money? Let's understand this. So, in the last video, we discussed that whenever the market goes up, it never goes up in a straight line or it never even comes down in a straight line. What happens is whenever a market is going up, it will always form these retracement patterns. Remember? Right. Now let's say if this market is going up, there is a retailer who is buying over here at this point because that guy is thinking this market is going to go up according to his analysis or whatever he is thinking. According to his analysis, this particular stock or asset is going to go up. So he is long over here, meaning he has bought the markets. So if the market goes up, this guy should make money, isn't it? Yes. So let's see what happens. This guy is long over here. Market goes up a bit and then started to crash down. It starts to crash down. This guy takes an exit over here, thinking that his analysis might be wrong, thinking that he might be wrong or his analysis might be wrong or whatever he was doing was wrong, and so he takes an exit. Now this guy was long over here. He takes an exit over here, which is below his buying price. So he is going to lose money. He is going to lose some money. So despite being long, he loses some money. He is going long over here. He exits. He loses some money. What happens after that? Market reverses back, goes up. Now this guy is thinking, I bought over here. I should have made money in this trade or this particular asset. Why did I lose money? Now this guy said the markets will go up. Let's say this is 100 level. This level is 100. This guy said the markets will go up. And now let's say the markets are at 130. So as he said, the markets did go up, didn't they? From 100 to 130. He was long on markets too, but still he did not make any money. Now this is where the play is coming. This move right over here is what causing all the confusion, and that move is causing troubles when it comes to mathematics of this market, because market says you cannot lose more than 50% of the time, but still people are losing. Why? Because this guy this guy entered over here. His analysis was right that the market is going to go up, but the problem was we all human beings think in a very similar fashion, in a similar way, at a similar point of time. And this is exactly what operators of the market are looking at to take advantage of. Because what happens is when operators get a bunch of a collective number of people at one particular place, they manipulate markets. It becomes very easy for them to manipulate when they get a collective bunch of retail people at one place. That is why the stop loss hunting in intraday trading or swing trading happens. We discussed that yesterday. That is the major reason why huntings and all these things happen. So just like this particular guy was long over here, there might have been 1 lakh, 2 lakh, 3 lakh, 10 lakh other people who are long at this particular level, expecting markets to go up, expecting to make some money out of this move. And this is exactly what spotted by the operators. That is why what they do is operators are long from these levels. So what they do is they start booking their profits over here. As soon as they see people are interested in this zone to buy this stock, they start selling. Their volumes drive the prices down, drive the markets down. Markets come down a little bit, they retrace, and these people, all of these people who are long in this zone, are hunted out, are taken out. And once all of these people are taken out, these institutional players start to buy again in these levels, only to take the market up. Now, if you see, if we compare this to mathematics, let's say we had 2 lakh people over here, out of which 1 lakh were long at this particular point and 1 lakh were short at this particular point of time. Okay, so now what happens is those 1 lakh who were long had to cover their loss, had to cover their position as soon as they saw that the market is going down. So these people got out. Then these 1 lakh people, they were short here for some reason or other. They had profits for some time, but then the market reversed back, went against them, and even these people had to cover somewhere over here or here or here. And what does that mean? What does we mean by cover? What do we mean by cover? Cover means to buy back the short position, meaning these people have shorted the markets first, so when they will cover, they will have to buy it back later. So that volume adds up to the institutional volume in this particular zone. So institutional people are buying anyways, but because the market is going up, these people are short. They are afraid that they might lose a lot of money, so they cover somewhere over here and here. And what do we mean by cover? Cover means they buy back their position, meaning the short position they had initiated in the previous times over here, they have to take it back, meaning they have to buy the stock now, which adds up to the volume, and then a furious move comes up. Then this process keeps on repeating, the markets retrace and then goes up. And this particular process is what the major reason why so many people are losing in stock markets. This process repeats on every time frame you can see. It repeats on 1 minute time frame, it repeats on 5 minute, 1 day, 1 month, 1 week, all the time frames. This particular process is common. And now, because of this, what happened? Most people out of these 2 lakh lost money. Most of them lost money. Despite being right, they lost money. Despite being understanding analysis and having some sort of knowledge, they lost money. And this is why we should understand how to manage our risk and how to manage our positions, because once you get to understand all these things, you can avoid or uh, you can better show some patience and understand markets in a better way. So rather than entering over here, you can enter over here with institutional people, and then your risk becomes significantly lower, and then you are riding along with those institutional people, and when you see another profit booking move, you can exit in this zone, thereby making you money. So how to do this? First thing was the Fibonacci retracement we understood yesterday. That will tell you a zone wherein market can show retracements. So that was the technical side. But to understand it in a better way, we have to understand risk management and position sizing. So let's understand risk management. All right. So what is risk management? Risk management in basic terms means managing risk. Managing risk. Now the example we just saw was the example which mostly happens with swing traders or investors. What happens with intraday traders is basically gambling. Most people come with the mindset into markets that, hey, I see those options going from 100 to 500 every day. Let me put in my money in one of those options. Let me make 2 to 3x of my money in 1 day, 2 day, 3 days, 1 week. This gambling mindset is what making people lose in intraday trading. Now they're happy when the FD offers, the bank FD offers them 5%, 6%, 7% per year. But when they come to stock markets, they want to double their money every single day. They do not hesitate putting 5 years of it, 5 years of their life into getting a college degree after school, but they cannot spend 5 months of learning time in share market to make a fortune. This is the sad reality of market. This is the sad reality of the world. Not only in India, this behavior of humans is pretty common all around the world. And that is why this technical analysis thing works in each and every market you can get your hands on, because the behavior of the humans does not really change no matter where you are in the world. No matter what race you are, people behave the same way. And that is why market operates on similar basis, similar kind of stuff. So once you get out of this gambling mindset, you will be very stable and consistent in terms of making money in markets. But to get out of that gambling mindset is very, very important. So let me ask you one question. Now, most of you who are watching this video are new to the markets. So I do not expect you guys to have a big capital. Let's say you guys have 1 lakh capital. You have 1 lakh capital and you are interested into intraday trading. You get this trade of some Tata Motors, let's say, some technical analysis you do, and you feel Tata Motors is a buy and you are going to buy Tata Motors on intraday. So how much are you going to risk on this particular trade? What is the amount that you are willing to risk in this particular trade? Answer me. I want to know. Whatever it is, just jot down your answer or speak out, because I want you guys to remember this concept for a long, long time, because this is what is going to help you make money in markets. Okay, some of you might say 5,000, some of you might say 10,000, some of you might say 3,000. All right, but this is not how you should be operating into markets. There's a way, there's a proper way and a proper defined number which you should be risking if you want to be stable in markets. What is that number anyway? How much you should be risking? 2,000, 3,000, 5,000, 10,000? That number is a magical number and it works fabulously, especially in the beginning phase of your trading. And once you understand and completely get the context of what risk management is, you can then define yourself those numbers, because then you are pretty much experienced yourself. But until and unless you are learning markets and getting experience of markets, you do not want to lose much more money in your beginning phase, because that will not only demotivate you, but it will also make you leave the markets. It will also make you quit the market. So the utmost importance for you guys right now is to keep your uh, losses small, keep your risk small until and unless you're learning. See, there's no denying that you are going to lose. I'm not denying that. You are going to lose, because everyone who has made a name in markets has lost significantly before starting to make money. So you guys are going to lose. So don't worry about that. But the thing we can control is how much are we going to lose? Just because you got a tip from your friend saying that, hey, buy HDFC Bank. This is going to go 2% up today. Should you be buying? You can think upon all those things. Should I be doing that? Would that really be a technical analysis entry, or would that be gambling? Because I am entering because someone else is telling me to enter. So you have to avoid all these things. You have to keep your losses as small as possible in the beginning phase and later as well, which eventually makes your chances of making money higher. So if you have 1 lakh rupees, how much are you going to risk? See, the number is never a whole number or a number directly, like 2,000, 3,000, 5,000. It doesn't work that way. The thing is, if you want to be like professionals, if you want to trade like professionals, you have to manage your risk. And to manage your risk, you must be comfortable holding the price fluctuations of whatever trade that you are taking. Meaning, let's say in the Tata Motors example we just saw, if you punched a trade with risk of 10,000 rupees, meaning if the stop loss is getting hit, you are going to lose 10,000. The price fluctuations that are there will make you go crazy, because when you risk more, which essentially means that you are punching more quantities than you can even afford to lose. And when you do that, you go out of your comfort zone and you start to panic on every small tick, every small movement that the chart is making up. But that is why we have to avoid that. And to what we have to do is basically have to stay in the comfort zone. Price fluctuations should be in our comfort zone. If the price fluctuations is making you panic, if the price fluctuations are making you uncomfortable, then probably you are not in your comfort zone. And that is why staying in the comfort zone in this particular field is very important, because then you can optimize your brain a little bit more and work on, holding on to those winning trades, work on getting more results, work on getting better at trading, and all those things. So enough of talk, let's understand risk management. So you guys answered, some of you guys answered 5,000, 10,000, 2,000. But let me tell you, if you have a capital of 1 lakh rupees, you should not be risking anything more than 1,000 rupees. How did I derive to this number? Did I did I do some mathematics? Was there some logic behind this? Why 1,000 and why not 2,000? The reason is that no matter how big or how small your portfolio is, you should always keep a check on your risk by managing your risk, by managing your cash. And the best way to do is to take not more than 1% of the risk of your entire capital. It will differ for people who are having big money, because on the bigger money, even 1% is big. So on bigger scales, bigger accounts, 1% is not normal. They take usually 0.2 to 0.3%. But on a smaller cap like 1 lakh, 2 lakh, 5 lakh, or even 10 lakhs for that matter, 1% is what you should not be exceeding. If you exceed anything above 1%, you are most probably going to go in the discomfort, uncomfortable zone, panic mode, and then lose. So you have to understand that you should not be crossing this 1% barrier, at least when you are in the beginning phase. Let's say someone's capital is 2 lakh rupees. So what is going to be the 1%? 1% is going to be 2,000. 3 lakh, 3,000. 50,000, 500. You can use calculators for all those things, although it is not needed, but you still can use calculators to find out what 1% is. But the best way is to cut off two zeros from your capital. Like you have 1, 2, 3, 4, 5. So you have 2 lakh capital, cut off two zeros from the last. That is what your 1% is, 2,000. So remember this thing. I want you guys to promise me today that you are not going to risk more than 1% on any of your capital, no matter how small or how big your capital is. Until and unless you are into this learning phase of markets, you are not risking more than 1% of your capital. You need to promise me that, because if you are not following this particular rule, you are really going to pay a very heavy price for that in future. All right. So there are two aspects to risk management. First one being this, that you shouldn't be risking more than 1% of your capital. And the second aspect is what we call the risk reward ratio. Risk reward ratio. All right, I guess my internet is down. Let me connect it and get back to you. Okay, so the second aspect of managing your risk is risk reward ratio. What exactly is risk reward ratio? Let's keep things simple. Risk reward ratio is basically what kind of reward are you expecting for the risk you are putting in, how much risk are you going to take, and then how much reward are you going to expect for that particular kind of risk that you're taking. All right. So let's understand risk reward ratio in a better way. Let's consider for example purpose that your capital is 1 lakh rupees. All right. Let's consider for example purpose that your accuracy. What is accuracy? Accuracy means the winning rate. What is your winning rate? How many trades do you win? How many trades do you lose? Let's say in 10 trades, if you lose 5 and win 5, which means your accuracy is 50%. If you lose 4 and win 6, accuracy is 60%, so on and so forth. So what is your accuracy? For example purpose, let's take 50%. I'm not taking 60, 70, 80 or 90% accuracy, the kind of accuracy Twitter gurus are claiming, YouTube gurus are claiming. No, let's be realistic. In my opinion, 90% accuracy is inachievable. The best traders in the world have accuracy of 60%. I'm talking about the best traders in the world. Traders like Ed Sikota, uh, Simons, and then there's this Ray Dalio. So all these people, they have an average accuracy of 60%. So if we are expecting an average accuracy of 80 and 90%, then we are probably saying that we are better than the best traders in the world. So do not expect accuracy of 90, 80%. No one has that kind of accuracy, and even if someone is having, that is very short-lived. Someone is in a golden period, then that kind of accuracy can be claimed, but once the golden period is over, that kind of accuracy does not replicate itself. So for accuracy purposes, for example purposes, we are taking 50% of accuracy, which means in 10 trades, we are going to lose 5, we are going to win in 5 trades. And we have 1 lakh as our capital. Let's say you are winning 10 trades and you are losing 10 trades. Now the thing is, what kind of reward are you expecting? Like the risk is final. We saw that we are not going to take more than 1% of the risk, which means we are going to risk only 1000 rupees. But what is the reward that you are expecting? Are you expecting 1000 rupees, or are you expecting 500 rupees or 200 rupees or 1500 rupees? Let's see. When you, let's say in a month, or let's say just randomly you do 10 trades, out of which you 5 are winners, 5 are losers. In 5 winning trades, let's say you take risk of 1000 and reward of 1000, meaning when you lose you're going to lose 1000, when you win you are going to win 1000 rupees. So when you win on 5 trades, you are going to make 5000. Similarly, when you lose, you are going to lose 5000 as well. Isn't it? Is this clear? Because your accuracy is 50% and the reward you are taking is exactly the same, the risk you are taking. Now at the end, how much did you make? How much money did you make? You must be thinking, I made zero. But that is the wrong answer. If stock markets operated on plus 5000 minus 5000 is equals to zero basis, then I guess 80% of people would have made money. But this is where the thing comes. You are not at zero, you are at minus 2000. Wait, what? I did not even lose more than zero. How am I minus 2000? Thanks to taxes. The transaction taxes, the brokerage, the GST, and whatnot. You end up paying roughly 20% of the taxes when you are doing trading. So 20% of this is 2000. And no matter whether you are winning or losing, you still have to pay the tax, you still have to pay the brokerage, I'm not talking about income tax. I'm talking about the securities transaction tax, which you have to pay no matter whether you are making money or losing money. The tax, the brokerage is going to be there whether you make money or you lose money. So in this case, we saw the risk reward of our risk reward ratio was 1:1, meaning you are making 1 rupee for every 1 rupee you are losing. And the risk reward of 1:1 is totally not working for us, because even if we are managing to stay at a zero, we are still ending up giving 2% of our capital for free, because our capital is 1 lakh rupees. This is 2% of our capital. We are end up giving 2% of our capital for free. We shouldn't be doing that. So 1:1 does not work. So just forget about taking 500 and 200 rupees profits. For risk of 1000, you cannot afford to take even 1000 profit. Forget 500 and 2000. Anything below 1000, you're going to end up losing more. So what is the risk reward? Let's try 1:2 now, meaning we are taking a reward of 2 rupees for every 1 rupee we are risking. Would that work out? Let's see. Now again, in 10 trades, you lose 5, you win 5. In the lost trades, how much are you losing? You are losing 5 multiplied by 1000, because you are losing 1000 on each trade, that is 5000. When you are winning 10,000, because you are winning 2,000 on each trade. So 2,000 multiplied by 5, because we are taking a risk reward ratio of 1:2. What that means is, when we lose 1000. When we win 2000. So 2000 by 5 is 10,000. You end up with 5000. We at least are profitable. But then these taxes come, and then you are left with only 3000. That is 3% of your capital. Now 3% on the capital on a monthly basis is a very good return, provided you have a very big capital in the first place. 3% on 1 lakh capital is of no use. What are you going to do of that 3000? If you want to grow, you have to grow at a faster pace when you have smaller capital. You cannot say, okay, professional traders are doing 3% a month. Let me do the same on my small capital. You will never grow. So you have to take some risk. You have to show some more patience and some more discipline when you are with small capital, because 3 and 4% is not going to take you anywhere. So what is the thing? How do we do? What do we do? 1:1 is not working. 1:2 is not working. This is exactly where most people fail to understand risk management. This is exactly where most people fail to understand risk management, because the magic happens when you start to take a risk reward of 1:3 or more. 1:3, what is happening to this? Or more. This is where the magic starts to happen, because now when you lose on 5 trades 1000 rupees, you're losing 5000. When you make money on 5 trades, you are making 3000 per trade. Multiply by 5, that's 15,000. And now you're profitable 10,000. And now if you go back to taxes and all that thing, you still end up making 8,000 rupees. Now that is not bad. That is very good. That is how you can actually start growing. Now it sounds easy to say that, okay, lose 1 rupee when losing and make 3 rupees when making. But is it that simple? Is it that simple? Let's understand it. Is it that simple? And is it not? And why is it not if it's not? Let's say you get a trade. You get a trade somewhere over here. According to you, this market is going to go up. You keep your stop loss over here. Or let's say bigger stop loss below this resistance, which is acting as support now. So you keep your stop loss over here. Now let's say for this example purpose that the current market price of this asset is 100 and your stop loss is at 97. Okay, so now what this 1 is to 3 essentially means is you have to take a target of 109, which is going to be somewhere over here. You have to take the target of 109, which is somewhere over here, because you are losing 3 rupees. Taking 3 rupees for 1 rupee is going to mean you are taking 9 rupees for 3 rupees, the 1 is to 3 risk reward ratio. It sounds easy, it is easy in calculation. The thing is, are you having the patience to hold the markets until they reach 109? Because you know one thing for sure, that they are not going like this and giving you money. They are not going to come like this. Never, never in your life this is going to happen. If market is going to give you money, it will check your integrity first. It will check your confidence first. It will check your discipline first. So the moment you punch a trade over here, most probably market will start going down. Happens many of the times. Then maybe the markets will head up again and you will feel relaxed only to dip down again. Your stop loss will almost be hunted and then they will actually go up and hit your target. So are you confident enough? Are you uh, disciplined enough to stay in the markets to actually let it do its work? Are you patient enough for markets to do them what they want to do? Because just because you placed stop loss over here does not mean you will not exit until the stop loss is hit. When you see such moves coming against you, you will exit here only. You will say, "Arey, this is losing, let me get out at 98 or so before it goes to 97." That would be your mistake, because it would just reverse back, go up, come down again, and then hit your target. So it is never going to be easy to hold 3x of what you are risking. It is going to be very difficult. It is going to be very, very difficult. And there are most of the people, what happens is they trade in greed and fear, meaning when they have entered at 100 and they have a stop loss at 99. Now why you keep stop loss over here? For some reason, na? You saw some support over here at this level or so, let's say, and that is why you kept stop loss below that support, because you saw that this market might come over here and then reach up. What happens when you trade in greed and fear is, once the market comes down and let's say takes your stop loss, you are still hoping that the market will reverse and give you profits. Instead of just taking and getting out of your position, taking that small loss and getting out of that current position, what most people do is they keep hoping that this particular trade will reverse in their particular favor and then it will make them money. This is the major problem why so many people in markets are losing money. And when the markets actually go in their favor, like from 100 to let's say 102, what these people do, most of the people, they say, okay Baba, I am making currently 1000 rupees, let me get out at this 1000 mark before it turns against me and gives me losses. Most people get out at small profits, thinking that let me get out at profits when the market is giving me profits, because after that it is going to turn against me. What happens is, at such times, these people who enter at 100 exit at 102 when their target is 109. They exit at 102 at some highs, then the market retraces back and then they start to feel, oh, see, I knew. And then they start to feel good that they exited over here and did not lose their money. But this move is not really the move the market is targeting to. The market is, this is not the direction where the market is actually looking to go. This is just retracement move, like the retracement patterns we talked about. This is just a retracement move. These people feel good that they exited at proper the top levels of the market and feel good for 5 minutes. After 5-10 minutes, market reverses back and shoots up. And then they feel bad that why did they exit? They should have waited, they could have waited, they could have made three, 4 times more money. Why? This is how human emotion operates. This is how all the people in the world trade. All the retailers in the world trade. They trade on hope, greed, and fear. And when you are trading with greed, fear, hope, and all these things, the basic emotions, what you do is you do not analyze markets in a rational way. You analyze markets in an emotional way. This was an emotional exit. Just because market is giving you 1000 rupees, exiting is an emotional exit. It is a bad exit. Did the market give you any reversal sign? No. Did the market tell you that or give you any signal that it is coming down? No. You must anticipate all these moves, na? You must be ready to take some retracement moves. If all you want to see is your profit and loss, I mean the profit at always the highest level, you are not going to make money in the markets. If you want to exit at the highest possible point, you are not going to make money in the markets. If you feel that you saw 2000 rupees profit and you exit at 2000 and then the market should start going down, it is not going to happen. Almost every time in life, whenever you trade, this is never going to happen. You are not going to able to exit at top or bottom because that is not how market operates. It is waiting for people like you so you can come up, get trapped in that particular move, and then the market can go in real direction. So what happens here is this guy had stop loss of 97, which was 3 rupees stop loss, exits at 102, which is 2 rupees stop loss or 2 rupees profit. He is not even taking 1 is to 1. Forget 1 is to 3. He is not even completing the 1 is to 1 risk reward ratio. Is probably somewhere or 1 is to 0.8. And what happens when you make less than 1 is to 1? Even 1 is to 1, we saw that you are not going to be profitable even by 1 is to 1. We saw that just now. By 1 is to 1 also, you are not going to be profitable. So if you are going in below 1 is to 1, just forget that you are going to be profitable. If you are taking such emotional exits, you are not going to be profitable. What you should have done is, what this person should have done is, he should have let the market work. Rather than exiting at 102, he could have thought, okay, what I can do is, rather than exiting, let me trail my stop loss from 97 to, let's say, here. Let me trail it over here. Let me trail it to cost. I have entered in 200. Rather than exiting and taking some small profits, let me trail my stop loss to cost. So if the worst case scenario happens, maximum that I'm going to lose is 0. Only the taxes I'm going to pay, transaction taxes I'm going to pay, but at least now I will not lose money. But what did he do? He exited at 102, thinking that this was the high of the market, thinking that market might reverse and give him losses. And this the market did reverse a bit, only to shoot up later. Has happened to you? Has this happened to you? I bet it has. It has happened to everybody. Because this is how the market operates. This is why 95% people are losing money. Because this guy was positive or long on markets because he thought this particular asset is going to go up. The asset in fact went up, but he did not make any money. Because out of this 102, this whatever he made out of these 2 points, he's going to lose much more than he thought in taxes and transaction and brokerage thing. So he's technically going to be handed only a few pennies. Only if he had waited until his target, he could have got more money. He could have really made some money. Now think about it. What do we do as a retailer? Even I started off by doing all these same things. We all do the same things, but learning from mistakes is important. We do not do that. We do not learn from our mistakes. So first thing in risk management is to respect markets, respect risk, and take not more than 1% risk, no matter what you are trading, no matter when you are trading, no matter how you are trading. The second is to get a risk reward of at least 1 is to 3. And to do that, this sounds very simple, but trust me, when you go into markets to apply all these things, it is going to be very difficult task. It is going to be very difficult task because market does not give money just like that. It will test your patience, discipline, knowledge, confidence, and only then it will give you money. And then two things that we understood that you do not have to do. The first, basically emotional trading. If you enter if you enter at this level and you have stop loss somewhere over here, if the market comes down and takes your stop loss, get the heck out of there. Do not wait in anticipation or hope that the market is going to reverse from here, because it never will. And if it does, what you can do is, if you exit over here, just when your stop loss is out, just exit out of this trade. If it does reverse, enter back again. Who is stopping you? Isn't it? If it is taking your stop loss and you feel that this is going to go up, let it show some signs of reversal, na? Let it at least show some signs of reversal. If it comes back again showing you some signs of reversal over here, then you can go long again over here, keep stop loss over here, and then trade that way, rather than just thinking and hoping in anticipation, sitting that this market is going to go up. It will never. It might retrace back to your cost. You will feel good that, see, I knew the market is going to go up, but this is again the retracement move we talked about. Then the markets will start to go down even furiously. So never ever trade on based on emotions, never trade based on hope and greed, fear, and all those things. We have another session to understand how to control emotions and uh, how these things work, and basically how to operate in markets without emotions. But just giving you a basic idea and hint of how not to work along the markets with emotions, because this is what will kill you. This is basically gambling. You have kept your stop loss here for a reason. Respect that stop loss and get out of the trade when the stop loss is hit. All right. Similarly, when your target is hit, now this is on the greedy side, that people become greedy. Like let's say they entered over here, their target was here. Now the target is hit, and now they feel that market is going up. Now let it go up. I will make more money. This is also a wrong approach towards market. Just because the markets has crossed your targets and is going in your favor does not mean that you are allowed to stay in the markets for even longer. It is okay if you are a professional, because a professional knows how to trail stop losses, how to trail targets, how to stay in the markets. But as a retailer, we lack all these things. So when your target is hit, my humble advice is to get out, because you keep your targets based on some resistance levels or something, isn't it? And when a resistance level is hit, what markets will do is it will go up, trap some people, trap some new buyers, make people think that it is going to go up, and then bang, reverse back from there. And what eventually ends up happening is, you had your target reached, but you did not exit here. Let's say you had a profit of 3,000 over here, you did not exit over here. Then the market started to come down slowly, and here your profit shrink to 2.8k. And now you were reluctant to exit because you wanted 3k again. So you think, okay, let it go back to 3k again and I will exit at 3,000. Never happens. Market comes down again. At this point it is at 2.5 thousand, and now you feel, why should I take 2.5 thousand profit, 2.5k profit, when I could have taken 2.8k or 3k? So you do not exit at this point as well. And this is how market keeps coming down. You keep losing the gained profit and eventually takes your stop loss. This is basically emotional trading. This happens when you trade on emotions. So we'll have a session on this thing as well. But I hope you are understanding risk management, because until and unless you're managing your risk, you're not going anywhere in markets. Managing risk is probably the number one thing that helps any profitable stay profitable for a longer period of time consistently. So never ever risk 1% more than 1% of your capital, and try to take a risk reward ratio of at least 1 is to 3. At least 1 is to 3. It is easier said than done because I know it is very hard, but you have to practice patience. When you are in a profitable trade, you have to practice patience. You have to let run your winners. You have to cut short your losers. You have to have that you must get that ability if you want to stay profitable or want to get profitable. What professional traders do is they keep their winners long. They keep their winners long and cut short of their losers immediately. So that is exactly what you should be doing as well. Okay, so aim for that. Manage your risk well, manage your risk reward well, and in next session we are going to understand position sizing. So anything you have doubts about, you can rewatch this video. Don't go ahead until you are clear about the concept of what risk management is, because until and unless you are clear about those concepts, you're probably going to have a hard time understand what position sizing is and the other concepts that we are going to cover. So I will see you in the next session where we will understand position sizing. All right. So bye bye and take care.